Thanks, Ben, and thanks everybody for listening in. I'm going to share my screen if I can work out how to do that with my controls here. Now, I hope that looks fine to everybody. What I'm going to talk about, and really the key message out of this, is that if you're working in development or rural economic development, it's really important, if you want to capture the ear of Treasury and get projects approved, is to talk about productivity rather than production. Now, just about everybody talks about production. You wanting to increase the area of production by building new dams, etc. But really, it's productivity that's important. So, to explain why, I'm going to explain some of the concepts. So, a couple of the advertisement shots for RECoE up front. And I'm talking here in the sort of the economic tools area, still similar to the other areas that I've focused on. So, productivity. So, a very famous quote by Paul Krugman, who's a Nobel Prize winner, said that productivity isn't everything, but in the long run, it's almost everything. And this is in terms of economics. So, ultimately, how fortunate a country is in terms of its economic standard of living depends almost entirely on improving productivity. And by that, we mean output per worker. And if we just focus in on rural economies and the agricultural sector, there's a fascinating story there about how changes in our rural landscape are explained by changes in productivity. So I want to start by talking about what is productivity. So ignore the equations, but all this is really saying is that productivity is really the ratio of how much we produce, so the volume of production, compared to the inputs. I'm going to talk about agriculture on the next few slides, or in most of the slides, but just as an example, imagine we have a single output, so the kilograms of beef production, and a single input, the area of land. Then the productivity would be the ratio of kilograms of beef to the hectares of land. We use the term total factor productivity. That just means that we're looking at multiple inputs and multiple outputs, which I'll explain further. So that's all productivity is. It's just the ratio of your production to the inputs you use to create that production. So total factor productivity, what's being attempted there is to identify what's the ratio of all the outputs produced off a, say, a farming enterprise or a farming sector compared to all the inputs. So imagine you've got a beef enterprise. The outputs will be kilograms of beef, but also hides and perhaps a couple of other outputs. And the inputs will be labour, fuel, materials, machinery, perhaps breeding stock, etc., etc. And so what we're trying to do is to compare the outputs relative to those inputs. Now, the Australian Bureau of Agriculture and Resource Economics, ABARES, the Productivity Commission as well, they publish these measures of total factor productivity in agriculture. And they compare this productivity figures from year to year over time. So you can see how there are changes over time. You can see how your sector is performing. I've done some of this work with agriculture. One of the exercises I did with one of my PhD students a few years ago, we got a whole heap of data for beef producers in Queensland, and we identified what their outputs were. So we had a way of assessing the outputs. You know, they're selling off fattening stock or breeding stock or store steers. So we got the value of their outputs, and then we assessed their inputs. So how much did they spend every year on fuel, fodder, livestock, etc., etc. And we made estimates as well about their labour inputs. And then we were able to identify from that how important the different inputs were. We could identify which of the properties or which of the enterprises appeared to be more efficient. And we could identify, because we had data over time, we could identify how this was changing over time. So we could actually work out what the annual improvement in productivity were for the beef enterprises in Queensland. So we did a really detailed case study. ABARES does an agricultural survey each year, and they basically use the survey data to crunch a similar sort of an estimate by farm sector. It's not simple to do, and the reasons it's not simple is that every property or every farm is different. So you've got all these multiple inputs and you've got the multiple outputs. And so you're trying to summarise the inputs in a standard way to do your analysis, but it's not always easy. And there are challenges, of course, with the outputs. It's becoming even more difficult, I think, because we have a lot of properties where we've got people working part of the time on the property, part of the time off the property. Working out what your labour inputs has probably become more challenging rather than less challenging. But what we're looking for is to identify, first of all, what are the most efficient producers? So essentially it's the efficient producers that set the benchmark in terms of production. They're also the ones who set property prices, because they're the ones out there who are expanding. And we're always interested as well in what the gap is between the most efficient producers and the least efficient producers, because that gives us some idea of how much you could improve your sector if you could just get your less efficient producers to be closer to the more efficient ones. You can wait, of course, for this to occur naturally. So if it occurs naturally, what happens is your less efficient producers over decades go out of production, and the more efficient producers buy them up in a type of a consolidation process. But it's nicer for everybody involved if you can actually bring your less efficient producers up to be more productive, because then they make more money, the sector as a whole makes more money, and people have got more choice about what they do. So I'll talk a little bit about this at the end, but when we're talking about productivity, where does it come from? Well, there are four main ways in which agricultural enterprises become more productive. And it's not just agriculture, it's the same sort of thinking that goes into understanding what happens in mining, in manufacturing, or in the services sector. But so in agriculture, the first big way that productivity improves is through technical change. So you get better technology, you know, what they're calling it smarter farming systems. You improve your genetics, you improve your infrastructure. The second big way is that farmers become more efficient at using the technology. So now we're just starting to see, I think, some really smart farming systems coming in to agriculture, where, you know, for instance, where we can start to do walkover weighing with beef enterprises and integrate that into animal production data. so that we can improve our reproduction rates in beef production and improve our animal selection. So I think we've seen we've always seen this adoption of technology and technical change. We still, I think, to see the real benefits of technical efficiency coming through. The third big area is scale efficiency. Now that is huge in Australia because there's been this exodus of people from farming, and essentially it's occurred by smaller producers getting out and the bigger producers getting bigger. And in the 70s and the 80s, that was the mantra of improving production in farming. You get bigger or you get out. It's not always true, but it's an important option. And the third big one, the fourth big one is your mix efficiency. So there's two dimensions to this. The first is getting the right mix of outputs. So what should you produce? We just had that discussion about should you be producing sugarcane or macadamias. And we can see all these farmers starting to change their output mix. But the other thing is your input mix. So what's the right mix efficiency of your inputs? I haven't got a picture to show you in this diagram, but it shows the labour productivity analysis in Australia by sector, which is produced this year by the Productivity Commission, which shows that agriculture is the worst performing sector in our economy in terms of labour output. So essentially labour is not improving, or the labour productivity in agriculture is not improving for whatever reason. And what that does, it drives the change to replace labour with technology. So we're going to see smarter farming systems. We're going to see mechanical pickers, mechanical harvesters. Because if labour doesn't improve in productivity, it gets replaced. We're seeing it a lot in mining, and I think we're going to see it a lot more in agriculture. So I'm going to talk a fair bit about improvements in productivity. And just to understand what this is, there are two main ways of thinking about it. The first is where you've got a given set of inputs, but you're producing more for those given set of inputs. So your output is increasing. Or, secondly, where you've got the same output, but you've got a smaller set of inputs. So it's like comparing a car built 50 years ago to a car built now. The cars built now are more fuel efficient. They don't have as much weight in them and don't have as many materials. They're smarter. They're more productive. Now, if you become more productive, it suddenly means that you're not using as many inputs to produce your outputs. So you suddenly are a lower cost producer and you're therefore more competitive. That's why this is so important. As the Americans say, the challenge is to build a better mousetrap. And by better mousetrap, it means anything that you're trying to produce. If you can build a better mousetrap, then you're in the box seat in terms of having customers. So let's look a bit at what's happened over time in agriculture in terms of productivity. So this is just one little look at what's happened in wheat. And I think that this graph's a tiny bit misleading, but it's looking in particular at what's happened with nitrogen. And you can see that up until 1900, wheat farmers were essentially mining the soil. So they're planting wheat without really any understanding of the nitrogen needs. So the soils became depleted. And then they started, from the 1900s, they started to understand the problem. A bit of science got involved, and they started to add superphosphate. We brought in lots of superphosphate, or lots of phosphate from Nauru, lots of mining there, chucked out over the fields, and it improved yields. But there's also increases in cultivars, increases in or changes in farming techniques with the fallowing. And over time, this has improved. So over a long period, productivity in wheat production, or the yields in wheat production, which is a measure of productivity, have gone up because of all these different ways of being smarter about growing wheat. And one of the things that's really important to understand is that productivity is different to production. Productivity is one of the factors that increases production, but it's only one. So the graph before was about wheat production and nitrogen. It's shown up the top. The graph in the middle shows the changes in wheat production in Queensland over the last few decades. It shows that wheat production has gone up a lot. It's very variable because of the climate, but generally there's been an increasing trend. The graph on the bottom shows wheat production or grain production in Australia over the last 150 years, and it shows a staggering increase. Now this occurs because of a few reasons, but the most important reason would be that we have increased the area available for wheat. And similar to what happened in North America, originally wheat was grown in the more fertile and more the better climate zones closer to the coast. But then with better breeding, it became possible to grow wheat in the drier zones. And so suddenly the area available for production increased dramatically. So we're not really factoring in well, I don't think, into some of these productivity numbers, the extra areas that we're able to grow grains in because of our better adaptation to drought and lower rainfall areas. But you can see the huge increase in production in wheat and other grains, and some of that is because of increased area, but some of it is because of increased productivity. And generally, that's been the story in agriculture, certainly over the last 100 years, but even over the last 50 years. So in the last 20 years, in this graph, you can see that production of meat has gone up by 53%, even though our cattle herd hasn't changed that much. Grains gone up 18%, fruit and vegetables 34%, and forest products up 17%. Now, this doesn't account for every sector, so wool actually has diminished over this time, although it's coming back at the moment. So one of the reasons why our meat production's gone up is that there's been a bit of substitution of cattle for sheep. So it's not always because of productivity increase, it's also because of other factors. So distinguishing between production and productivity. So production is the total output, and that's tended to go up as the previous graph has shown. But sometimes it's gone up simply because there's been an increase in inputs. And in the top graph here, I'm showing wheat production and mapping how wheat production's gone up, but it's pretty closely aligned with increasing fertiliser. So it's gone up because of increased fertiliser. And it's probably also gone up a little bit because of some changes in land area, although over the last 30 years, that hasn't been as big a factor as it was in the 30 years previously. But look at the graph below. Now, this is wheat production globally in the world. Now, the dotted line on the bottom shows the area that's used for wheat production, but the full line on the top is the production. Now, this shows that area hasn't changed much globally, but the amount of production has gone up by 2.5 times, or nearly 3 times. So that change in production is probably partly due to extra inputs like fertiliser, but a lot of it's probably due to doing it better, which would be a productivity change. So we know that the land inputs haven't changed. Fertiliser inputs probably have, but people have become a lot better at growing wheat for a variety of different factors, and that's led to this dramatic change in production. So, a pretty good story so far, but some of the complexities of it explain why we can't stand still on this. So one of the confounding factors with productivity is that the faster you can increase production and the cheaper you can increase production, the more you tend to drive your commodity prices down. So this is what's happened with wheat and wool prices from in the last, almost the last 50 years. And you can see there's a generally declining trend in both wheat and wool prices over time. This maps a lot of what's happened in commodity areas. But essentially, not always, but essentially the main reason why these commodity prices go down is that globally we become more efficient at producing them. You don't need as many inputs, and then competition for the commodity drives prices down to just above what it costs to produce plus a profit margin, because that's what producers will accept in a very competitive market. So you can see that if you read between the lines, the fall in prices from 75 through to 1990 meant there were probably huge improvements in productivity globally. And then from 1990 through to 2015, not really much change globally. So it probably meant that productivity increases had stagnated. Now, that makes sense in some ways, because remember that from 65 on, roughly, we had the Green Revolution in developing countries, which led to massive increases in agricultural production. So a lot more supply, and essentially lowered prices and drove prices down. I'll talk about that a little bit more later. This is another graph, which is it's a little bit dated now, but the story hasn't changed that much. And this shows that commodity prices, it's not just agriculture, but in other commodities, have generally trended down. They've trended downwards in the last 100 years. They've trended downwards in the last 400 years, if you look at longer term data sets. Agriculture certainly has done that. It's happened in most areas. What's interesting here is that there's been a blip in the 1970s, a blip upwards, and there's been another blip upwards from roughly about 2005. And let's open it up here. Is anybody able to suggest why there were these two blips upwards? The first in the mid-70s and the second after about 2005.
Oil supply and price?
Well, the oil supply in the 70s basically went up because of stagflation. So remember we had OPEC and Alibaba and the 40 Thieves in 1970s basically formed a cartel and pushed oil prices up. And so what happened then was that basically pushed up the input prices for a lot of production around the world. So it forced the prices of other commodities to go higher simply because it costs more to produce them. So that's the story in the 1970s in a nutshell. What about from 2005? What's caused that spike upwards since then?
John, it's Helen here. What about in the 2000s, there was a lot more trade going up into China particularly, and soybean demand was lifting substantially up there.
Yep, you're right on the money. This is the China effect. So China started to really go gangbusters and sucked in resources, has continued to do so. And that has pushed up commodity prices around the world across the sector. Now it's a little bit patchy because sometimes there's been a catch up in supply, which tends to flatten it out. But just for example, in the last few years, or in the last 3 years, we've seen that effect impact strongly into meat markets around the world because China's pigs are crook with their virus, with the swine flu. So they've had to purchase a lot more meat on international markets, and it's pushing up meat prices. So China, because it's such a big country, has these major impacts on world commodity prices that possibly no other country is able to achieve. So, but in the longer term, generally markets are pretty good at responding. So they respond and increase production. So productivity comes to the fore, production increases at a cheaper rate, and commodity prices tend to slide a bit further. So one of the difficulties is that it'd be nice to think, okay, the world wants to make things cheaper all the time. Let's just shut up shop and we'll ignore that. But the difficulty is that we're basically a very export-oriented country. We export and import-oriented, and we're really dependent on world markets. And the difficulty for us is that the changes in production and productivity aren't limited to Australia. So when other countries have these huge changes in productivity, so suddenly they can produce things cheaper, that makes it tough for our producers to compete. So it's really important that we can that we can get our productivity higher in order just to stand still in the world markets. So this goes right back to, if you like, the first industrial revolution. So England became really rich from the 1700s onwards because they were the first to industrialise. And essentially they had this massive increase in productivity. So they were able to produce a lot more output for a given set of inputs. And they did that because they mechanised, because they invented the assembly line, and because they were able to bring a lot of different factors of production together. But of course, then other countries copied, so particularly Northern Europe and then the United States. And that increased, allowed huge increases in production and wealth. And because there was the increase in production, then they needed population to grow, to provide labour into production. It happened particularly in the United States. And once you got greater production, greater wealth, then there was more power and a lot more trade. So these increases in productivity are really closely aligned with increases in trade. And what's happened in China is that China's productivity growth has been incredible compared to the rest of the world. So this shows it back since 1989. You can see how China's economic growth has gone up by 14 times between 1989 and 2018, far in advance of anywhere else in the rest of the world. And compared to Europe or the EU has got very low flat growth rates, which is one of the major reasons for Brexit. And that's one of the problems of these developed countries. They seem to be getting locked into these low growth rates that are making it difficult then to compete with countries like China. But one of the things that's happened in China is that they've had this incredible growth, which has made them wealthy. And then that creates the demand for increased consumption. They're wealthy, they can consume more, and then they want to trade. And Australia, of course, has benefited enormously from that, and agriculture is benefiting a lot from it. So this is a contradiction or a tension that's very difficult, I think, for the sectors to grapple with. So the tension is that productivity growth is what really is driving the extra demand for agricultural products. So productivity and growth in manufacturing and the services sector, in all of the different sectors, particularly in China, is leading to higher living standards and therefore higher consumption. And that's what's underpinning the increased demand for Australian resources, including Australian agriculture. But at the same time, that productivity growth is also occurring in agriculture around the world. So it's pushing down these commodity prices over time. And it means that Australia, the ag sector, has to be very focused on improving productivity simply to maintain its competitive position. So far we've done fairly well, but the challenge, I think, is quite intense. I'll just skip this slide to talk about the trends a little bit. So the trends in this total factor production, so basically the trends in productivity, they've increased a lot in the last 100 years, but particularly in the 90s, total factor production slowed down a lot. They've improved a bit since then, and they of course are variable because of the big droughts and the big climate effects that we have. And some of the evidence when we dig down into sectors or inputs like labour is that productivities, they're very low rates of increase. But what's happened generally is that the terms of trade have got worse for farmers. So that's shown by the red line going down to the right. And by the terms of trade, I mean that the combined effect of lower commodity prices over time and the Australian dollar, so essentially the prices that farmers receive in Australia, has tended to be lower and lower, although over the last 50 years, or sorry, over the last 25 years, since 1990s, it's flattened out a lot. That it's gone up a little bit from, you can see from about 2008 through to 2016 when this graph finishes. That's because the Australian dollar went up. Once the Australian dollar dropped at the end of the mining boom, that graph continued, the terms of trade graph continued to decline a bit. But the terms of trade have largely been offset by improvements in productivity. And that's the orange line sloping up to the right. So farmers receive lower prices, but they produced more for given inputs. So that meant that they were able to compensate for those lower prices. So this has been the story in Australia in the last 50 years, and it's likely to continue to be the story. We expect that commodity prices in the long term will continue to decline. There'll be ongoing competition from other countries in agriculture, so we've got to get smarter at doing it to be able to survive. Now, I talked before about, I said before that productivity growth is affected by drought. So we have these big fluctuations, which is shown in the orange line here. You can see it bouncing up and down. So in some years, in big drought years, we have to put a lot of inputs in. We've got to buy extra fodder, for example, extra labour, simply to maintain production. In the horticulture area, they've got to pay more for their water. So basically the inputs go up, but the outputs don't change. So when this is corrected for, this is data from ABARES, when they correct for this, you can see that productivity growth is sort of went up from the mid-80s to 1995 was flat to 2005, and then has increased again a bit since about 2005, and that's probably extra technology as well as some increases in scale of production. What would have happened if we didn't have productivity increase, if we just stayed the same since the 1950s? So this little exercise generated by a friend of mine in Canberra, and they were friends of mine in Canberra, they had a go at estimating what was the share of agricultural output from if Australia had continued farming as normal from the 1950s compared to what they're doing now. And you can see in the overall that agricultural production has increased, or the value of agricultural production has increased. But if we'd continued just with our current set of inputs in the 1950s, we would have dropped to roughly about a third of what we were producing. And so the improvements in productivity, so farmers doing it better, is accounting for roughly about 2/3 of production by 2013 when this graph was produced. So very important. That's why productivity is so important in the longer term. So understanding a little bit what's happening and looking down a bit closer to home. So the underlying drivers of regional economies, as you well know, this first started with a focus on changing land use to agriculture, finding new minerals, and developing value-added sectors like meat processing and minerals processing. We've added other industries into some of our regions, like tourism in Cairns and defence in Townsville. We've had these regions have been benefiting from infrastructure and services that attract businesses and residents in, and we've now got livability as a key attractant into some of our regional areas, particularly the coastal regions. But one of the difficulties that we've had in regional Queensland is that most of the growth that we've had in our economy has been in sectors that are not in the regions, such as in their service sectors. So the productivity growth has been much higher in our services sector than in our primary sectors. And because the services sectors tend to be in the major urban areas, they've become much more dominant. So they started simply because they were a focal point for trade. You know, they were a port where the agriculture and the minerals went out. So they were really sort of along the way, but they built a population base and then it's grown from there. So because productivity growth varies by sector, and it's hard to get productivity growth in sectors like agriculture, it's been hard to generate major economic growth in regions. And you can see this in these in this little graph here, which shows the relative share of agriculture and mining in Australia's gross domestic product. So the value of production in Australia overall, you can see in the 1800s, in the first half of the 1800s, it was about 30 to 40% of the economy. And then from the gold rushes, you can see the mining really taking off in the 1850s with the gold rushes, becoming more important than agriculture by 1860. but then diminished a bit. You can see it by 2000, by 2005, mining had become several times bigger than agriculture, and that's only increased. And you can see the growth in manufacturing steadily up to about 1970, after which the Australian economy became much more trade-oriented, much more open, a lot of competition, and manufacturing has declined since then. So, and when you think about agriculture becoming 2% of our economy instead of 35% of the economy, it explains a lot the relative change and importance from rural economies through to urban economies. The second big issue to talk about is globalisation, specialisation. So economic growth largely occurs through specialisation. We get smarter at doing things, we get more focused by applying technology and specialised labour. But as soon as you've specialised on something, then you can't produce everything else. So one side of specialisation is doing things smarter, but the other side is trading to sell your goods, as well as buying in the things that you don't produce. So specialisation and trade seem to generate economic growth, but they have to go hand in hand. But the globalisation has meant that instead of producing sort of everything in a regional area, or most things in a regional area, regions are now tending to produce just the agriculture that they're best at doing, and the mining that they're best at doing, and tourism, but not a lot else. And so specialisation and trade has meant that in regions we're tending to be left with only the key industries where we've got a competitive advantage. So only the areas that are able to have productivity increases to match what's happening elsewhere in the world are the only ones that are left. So 100 years ago, Queensland itself produced most of her own food, say all of its own milk, manufacturing. We had little towns had their own dentist and their own photographer, just as an example. And now there's been huge changes, and most service centres are in urban, major urban centres. And one of the outcomes of that has been that even while agriculture has been increasing in production, we can see that it's doing it smarter. So the area under farming is tending to decline over time, and the total number of farms is tending to decline as well. So we're seeing a lot more consolidation in agriculture, and it's part of becoming more productive, that getting larger scale enterprises and farmers doing it smarter. But it's certainly one of the consequences of that has been consolidation and a reduction in the workforce. And that's led to a lot of hollowing out of smaller communities, as you're very well aware. So very uneven population growth across Western economies and starting to happen in developing economies. And it's generally caused by these economic forces. It's going to be interesting once we get through this COVID curse, whether changes in workforce patterns mean that people will be able to work further away from their workplace, and that might help to re-stimulate some regional areas because of the lifestyle effects. The other thing that's happened, because we've got the productivity improvements are tending to reduce commodity prices, and that reduces the terms of trade. That means that there are these long-term slides in the importance of commodities, and that's tended as well to reduce some of the positive impacts in our regional economies. So agriculture has become less important relatively. We don't need as many people in it. We've become more productive, and but the growth overall has been lower than in other sectors of the economy. So one of the challenges of making these predictions is that the economic forces do bounce around quite a bit over time. So the terms of trade. So terms of trade is basically comparing what we sell to what we purchase. So can you purchase more for what you sell compared to in some years, which is when we're doing better, compared to other years when we're doing worse. And you see that by our terms of trade improved remarkably. It was actually at the Korean War. 1952 was when it was the best, and we were able to capitalise on wool production in particular. And we did really well in the mining boom in 2010 when the world couldn't get enough coal and iron ore, or China couldn't get enough coal and iron ore. And so we had this incredible amount of money coming in, which drove the Australian dollar higher. But you can see that in the Great Depression in the 1930s, again in the 70s through to the mid-90s, or roughly about 2000, we weren't doing so well at all. So the effects on the Australian commodities have been quite varied. But as a rough rule of thumb, the value of our exports, particularly wool, has declined dramatically over time. The resources sector, so that's mining and gas and coal, has actually done very well. Manufacturing did well for a while, but then diminished sharply from the 1990s onwards. But generally, the rural areas have been under pressure over the last half century because of the changing terms of trade. We know about productivity, so I'll just talk about how to improve productivity. There are different ways of improving productivity, but one way of doing it is to improve infrastructure so that it's easier for businesses to do better. And infrastructure these days means not just the hard infrastructure, but also technology. This is an example of the sheep industry. You can see that the sheep industry went through this huge decline in productivity in the 1990s following the collapse of the Wool Reserve Scheme. But since about particularly since about 1998, the industry's actually been improving in productivity over time. It's this orange bar here. So there's been a consolidation. Probably the more focused farmers are left in the industry, and they've actually been doing better in terms of improving production. Changes in productivity growth vary across the states. So South Australia and Western Australia and Tasmania to some extent have been doing best in the past. If we look at up to 2011, I don't have the update since 2011. You can see that it was Queensland, South Australia, Western Australia and Victoria that had the best improvements in agricultural broadacre productivity growth. So it does vary a fair bit by sector, across sectors and by state. And you can see here that roughly in the 1990s we had reasonable growth in agricultural productivity in that decade, 2.4%. But in the 10 years after 2000, it is only 0.42. Now that coincides with the millennium drought. So it's probably most drought related, but I think there was a little bit of a lack of focus on agriculture from government as well. And productivity growth since 2010 has been ramping upwards. So this is about the second last slide. we spend a fair bit of time as economists, not me personally, but trying to understand what's driving these productivity changes. And is it basically we want to improve the quantity of production for a given set of inputs, because that generates higher profits. We can do it because of increasing activity. So we can have farmers getting bigger enterprises. We can change the mix of resources. A lot of the focus of the sectors on, say, building new dams or releasing more water to agriculture out of the environment is really about substituting. It's increasing inputs into agriculture, but it's substituting from somewhere else. Really what we want is to improve our productivity effects. So we want better operating efficiency and better use of technology, because that's the way in which we achieve more with less. And that's the real output. So some of the opportunities for technical change in the future are through things like precision agriculture. You can see it happening at the moment. I didn't put in a final slide here, but really the take-home message is that when we're talking about regional development in Queensland and how to develop communities, what we really want to talk about is proposals that will increase the efficiency of production. It's fine to talk about changes in production overall, but remember sometimes that only comes because you transfer inputs from somewhere else. What we want is to improve labour productivity, we want to improve technology, we want to improve the efficiency, we want to change the input and the output mixes so we're producing more valuable products, and we want to do it in ways that are sustainable. So I think the take-home message here is that if you're looking for regional development opportunities, and particularly if you're writing proposals that have to go through Treasury or a Treasury department, it's really important to talk about productivity, because that's what drives lasting change and makes agriculture more competitive. So just increasing production without increasing productivity means that in 20 years' time we won't be competitive. You've got to get productivity up. Okay, I shall leave it there and take questions and discussion. Once I can work out how to stop sharing my presentation. So, some of you know a lot more about this or know a lot more about particular details than I do. So I'm providing more of an overview here, but any thoughts or follow-up?
John, it's Helen again. I was just wondering about, the move towards primary producers being recompensed for their land stewardship and, ecosystem services results that they provide for Australia as a whole, for the community as a whole. And when that starts to be brought into the, the revenue equation, that's going to be potentially quite a profound change, I think. Have you got any thoughts on that?
Yes, I do. So I think it's a really useful thing to do, but remember that there's been a lot of, I think two things that have occurred. One is that there's been a lot of degradation in natural assets from farming activities, particularly overgrazing. And the other is that there's a lot of substitution of natural resources from the environment into agriculture. So transferring, taking over areas of land, clearing them vegetation, or taking water out of rivers and using them through irrigation are probably negatives in some ways. So focusing on the ecosystem services, I think, is a really good step to try to redress that or provide a more holistic figure.
Mm-hmm.
So if you think about a farm producing not agricultural outputs but also environmental outputs, or environmental outcomes, then if we really want to be more sustainable, we should be considering both sides of the ledger.
Mm-hmm.
And I think it's, at the moment, it's probably focused on the farmers, on the positive side of the story. So the NAB, starting to take account of ecosystem services and their agricultural portfolio is a nice start there. But yeah, I think, one of the interesting things is, do we also look at the negative side of the ledger as well?
Well, I was thinking in a productivity sense, in terms of, I suppose, return to the producer from a certain set of inputs. I guess I was thinking about that particularly.
Yeah.
And if you think about currently, if other, I mean, setting aside the degradation issue, which is a bit more complex, but if you look at inputs that come from the environment, like irrigation water, well, they pay for that anyhow. So that's kind of wrapped up in the economic factors involved in their production.
Yeah, so with one of my colleagues, we did a paper a few years ago where we had to go at analysing data. So we got productivity data for these beef enterprises, and we matched it up to the ground cover data on their properties.
Mm-hmm.
And what we were interested in was showing that some of the more productive farmers were actually also the better, had better ground cover standard, and were doing a better job for the environment.
Mm-hmm.
And we did find some trends. The data was still a little bit mixed, so it wasn't as clear a story as we would have liked. But we thought that would have been the case, that where you find land degradation, it's people sort of making poor long-term choices for their own production.
Yeah.
Because in the longer term, they're, particularly in grazing, land degradation reduces outputs.
Mm. Yeah, no, thank you for that comment.
Yeah.
John, there's a question from Andrew. I think, Andrew, you should ask this question instead of me reading it out. Right.
Oh, I see on the chat. So you've asked has anybody analysed total factor productivity for rural LGAs? Are the stats available for LGAs? To my knowledge, no. I think, as far as I know, it's always been by sector. It's a good question. I don't know there. I'd be right to say that nobody's ever done it, but I've never seen it, put it that way. And Daryl suggested that the COVID curse, or COVID-19, may change production trends in Queensland, where we have to go back to producing more of our own food and manufactured goods. Well, that's an interesting one. I actually think that the economic forces here are very powerful. It's like China, stopping beef imports from our 4 plants at the moment. China's got a huge demand for meat. So the economic forces would mean that China would be very reluctant. It would be very difficult for China to stop meat imports from Australia altogether. They're a totalitarian country, so you never know what's going to happen. But the economic forces would suggest that they will continue to import meat. Now, it's the same with food production in Queensland. I'm not expecting that dairy farmers are going to become a huge growth sector in Queensland, because realistically it's still cheaper to produce milk in Victoria, and transport costs continue to fall in over the longer term. So it's becoming more and more efficient to produce where it's cheapest and then transport the stuff around. What I think though might change, it's interesting, a lot of people working from home, taking more time with their families, getting a little bit more involved in their local communities. So I think that subset of demands for locally produced product will grow. How big that market is, my guess is it's 3 to 5% of the market. So I think it'll grow a little bit, but it still won't be huge. At the moment, we've got a big survey out on meat consumption in Australia as a part of this research centre. And one of the things we're asking people is how their meat consumption has changed during this COVID period, and what they expect will happen with their consumption going forward afterwards. We're not really sure what the answer will be. We think there's a fair chance that because people have been home more and cooking more, that their consumption of meat might have gone up. But yeah, it's early days yet.
John, do you think in it's great to have that Krugman quote at the start, but in the R&D sector, it's interesting to see the 90s production increases, and then the millennials sort of decrease, but you said it might have been a drought-related one. But in terms of measuring, or let's look at R&D, say, for example, the performance of MLA. If you took that measure of 53% in terms of improvement of beef productivity, you'd say MLA, maybe our industry's done a really good job. Or, what have you seen in those sort of studies around industry led sort of performance and those things over your time that's of interest? Could you extrapolate on that at all?
Yeah, it's a fascinating question, actually. So there's some Australian economists and some US economists have looked a lot at this returns of R&D in agriculture. It's complicated because there are really long lags between when new information becomes available and you get widespread adoption in agriculture. And generally we talk about a 20-year lag to when research fully becomes adopted, or not fully, but the majority become adopted. And I often think of green cane trash blanketing in the cane industry as being one of the fastest adopted technologies in terms of a new farming practice. But then somebody in the cane industry told me, oh no, that took 20 years before it really became widespread. Similar with controlled traffic in grains, took a long time till it became widespread. So one of the difficulties that we have with measuring is that you have the research and then your effect occurs much later down the track when it's hard to distinguish. But as a general rule, these widespread studies, they've done some in Australia, they've done some in the US, and they've looked at how much spending there was on research and development in ag, and then tracked it to what's been the change in productivity and production over the next 20 years. And generally it comes out really high. So there seems to be a pretty high return.
Yeah.
I'm always a tiny bit cautious because these are academics who are predicting that that research generates great outcomes. So it's a bit the pot calling the kettle black, but the numbers seem to stack up at present. And yeah, and there's been a lot of the genetic work in crop production and in cattle has definitely led to huge productivity increases.
Yeah. That's good. There's a good question there from Simon, John. Simon Kuttner, about what are the levers that local government can pull to influence productivity?
I know, I think in local government, a lot of it is about arguing about getting your infrastructure right. So, and some of that's, you know, I think there's far too much focus on roads in our communities. I think we should focus more on IT. So infrastructure is really important. I think trying to encourage entrepreneurs is really important. So, and encouraging new types of production. A lot of small communities suffer from, or they're not always fully welcoming to somebody coming to town with a way out type of a production. You know, I remember forestry going into the RECoE area 20 years ago, and there's huge community opposition to it because basically the sugar mills were worried that any loss in sugar lands would, you know, would be detrimental to the sugar mills. So it's sometimes very difficult in local areas to get new things going. I remember I was asked to be an expert witness in a case in further up the coast where you know, new enterprise come to town, and the sugar mills were challenging all of the development applications you know, that the council were making, trying to stop this new agricultural proposal because it would involve some substitution of the sugar lands. So I think councils can be a little bit more supportive of new things going on. I've also suggested to councils that they might help to support that those innovative businesses. So for instance, Rockhampton is the beef capital, or you know, has this huge beef expo every 3 years. We get a lot of these secondary industries around beef coming to that beef expo, and some of them from international places. It'd be great to see those firms that are wanting to sell, you know, fencing equipment or whatever, that the local council made it easier for them to set up their Australian subsidiary in Rockhampton. You know, and we had special deals for that sort of thing. So I think finding a niche where there is a local competitive edge, and then trying to help that niche to get going, I think that'd be useful. And the niche, doing it that way, the niche varies. So to be beef in Rockhampton, it might be macadamias in Bundaberg, etc., etc. But I think positively trying to support new entries would be great.
So, sorry, just to follow up there. Thanks, Professor, for the session. Is it not so much about you talk about specialisation, and would that be preferable to diversification in examples like, so I'm in Longreach, it's a very I suppose rural and remote LGA, and we have agriculture and tourism, and they're the two sectors that are sort of really, I guess, matching those productivity gains outside the region, and that are actually sort of doing well. So is it less about trying to diversify into new specialties and actually concentrating more on the existing specialisation and trying to drive productivity in those? Is that the idea?
I think that's often sensible. I know that there's been almost a couple of fads, so in my opinion. So back in the 90s, there was a real fad for producers to try to become much more integrated into markets and to supply directly to their customers. So beef producers were encouraged to set up trading links with customers in Japan and sort of try to cut out all the middlemen. There was a lot of good thinking to it that was about getting to know your customer better, but in reality, it didn't work so well, trying to leapfrog the supply chain. And now almost all of those initiatives have disappeared. The second big fad, I think, has been this diversification. So looking to diversify in rural areas. But in reality, the world has, in the last 20 years, has just been turbocharged to specialisation. And that's driven in particular by the lower cost of doing business, of China producing things. And so you can see it in the manufacturing sector. You've really got to specialise and be very good at one thing. So I think in regions, it's more a matter of finding what the niche is and trying to build on that. So and in Longreach, you know, it's agriculture and tourism. I think probably the big opportunities are in tourism. It's pretty hard, I think, to find new. I think you can produce things in agriculture, but the thing that kills you there is the transport to get it to market. So it's everything I've looked at, you know, like growing dates in Longreach. It'd be, I think, somewhere else is probably closer to the coast, is shorter transport links, has probably got a competitive advantage.
Yeah, that's, well, okay. That's certainly something that we're finding. I mean, we have a desire among some producers to diversify in ag into some horticulture and you know, vertical farming, notional stuff like that. But yeah, actually generating a business case is a bit tricky sometimes. But no, thank you very much. And I tend to agree with you on diversification as well. It doesn't just apply to ag, but even our small business in terms of economic development, trying to, rather than, to quote Professor Queue, rather than look for an economic saviour, try and build up the existing businesses to be more productive and produce more for the community.
Mm-hmm. Yeah, I think so. I think what has ended up there already is generally what you're going to have.
Yeah. There's another question from Leon in the chat, which probably be easy for you to read, John, than me to read out. I might get it wrong, but it's around one of your slides.
Yes. So this is about the focus on quantity versus price. So in Australia, we've tended to, well, with commodities, we've tended to focus on higher volumes and lower price. And that's in some ways because it's easier for us. I do think that we haven't always got this right. So we do seem to be missing out on some value adding. Trying to make that happen a little bit better is tricky. It's interesting looking at some of these European countries where they have these quite strong manufacturing sectors and high-tech manufacturing sectors, and they seem to be able to survive competition from China because they've got people who've been doing it for generations, and they seem to have a lot of skills, very good labour force, a lot of entrepreneurial people who continue to make, you know, equipment or specialised technology. We don't quite have the same in Australia. I think we do, you know, we've got really good agricultural producers, but we're not, somehow we don't have quite the same focus on technology and know-how and productivity that some of our competitors do. So, yeah, trying to value add on our, well, I think trying to do two things with our existing industries. One is to improve quality, because that's really how we're going to survive competition. And value add is the second thing. But by value add, I don't mean necessarily, you know, turning hides into leather furniture. I mean doing what we do well, but improving it a little bit. So we're value adding, so that if we're selling meat to overseas markets, we start to provide information in there about all the credence attributes, so where it's been produced, who the producer was, what the chemical status is, etc., so that we provide better information about the supply chain and value add that way than any of our competitors can even hope to do.
My favourite value adding success story is wool classing.
Mm-hmm. So we classed it better. We were more accurate than other countries.
Oh, definitely. We definitely. It's often called the first stage of wool processing. So it was all based on the flock concept, and there was a lot of theory went into it because there's more variation in a flock of sheep. There's more variation on one fleece than there is in a flock. So that flock mob concept and things around uniformity and different types of parts of the fleece going into different things. And you built your sale lots on the mob because that was the most uniform that way. So, and it had the less variation. It's a highly variable product to process, wool, compared to cotton, being an animal fibre. So it was very important that you do wool classing, that it was classed to a standard. So Australia was always a leader in that particular sort of system, I suppose. It was, as you saw in your slides, how important a part of the economy was in the old sheep's back. It was. We have a very systemised and advanced wool marketing system.
Mm-hmm. Yes, yeah, and wool production was a very technical thing that a lot of people put a lot of effort into, and some of that history is almost forgotten now.
Well, it is. It was the first electronic transaction ever.
Yeah. Okay. Oh, I didn't know that.
There's another question from Helen on regional tourism productivity.
Productivity in regional tourism, yeah. I think that's a harder one because it's harder to measure your outputs. But the outputs are basically consumer satisfaction and consumer spend. So I think productivity is when you are achieving high revenues or high consumer spend for the inputs that you're able to supply, and one of the challenges in tourism for a lot of countries is that what starts as being a high-end product is quickly diluted into mass tourism markets that then achieve very little profit. So the challenge in tourism, I think, in terms of productivity, is to maintain your quality attractions and your quality products that generate both the satisfaction and the profit. And one of the difficulties we've had in Australia, perhaps it'll diminish now, but we don't have a lot of new, or certainly in Queensland, we don't have a lot of new product. And by product, I mean really high-level resorts, high-quality hotels, and perhaps new tourism offerings. It's one of the fascinating things at the moment. So what will happen with tourism with this COVID thing? So my estimates are that Australians last year spent $44 billion going overseas. And that's an enormous slug of money that you would imagine is perhaps open to domestic tourism to attract. It's not all money spent overseas because some of it would have been spent on flights. But even if you take 10 billion off for international flights expenses that might have started in Australia, it's still $30 billion. And I'd like to think that we could revitalise our tourism sector domestically. Because suddenly what I call the Bali effect is out of the equation, and the trying to match that to productivity then is, can we come up with new products that generate satisfaction and generate profits into the sector and service our domestic market?
that's really interesting to hear you talk about that. I'm not involved in the tourism sector, and I never have been, but I notice quite a few quite high-end accommodation, you know, sort of experiential packages. I noticed that sort of entrepreneurial people are doing in regions, and one I noticed was a family on their beef property at Warrialda, and they've set up, you know, really top-notch accommodation, and they sort of have a I don't know, kind of an astronomy kind of bent to it. And clearly there are people investing quite a lot of money into having a very good accommodation. But I guess the regions, they might be sort of more isolated instances. They're not really linked up, which would be where you could probably extract more value for an LGA from having it more linked up with other things in the area.
Yes, so I know there's been proposals to try to, you know, set up air services that would link Cairns through to our western centres, so that it would be easy for people for tourists to fly Sydney, Longreach, Cairns, or, you know, that coming up with those sort of combinations and being able to provide the quality product. I think there's potential. I don't know quite how to unlock it and make it work, but those are the things that we need to be trying to do. And I think, you know, in the next 12 months, there's a lot of opportunity to talk to government and say, can we try a couple of things and get Australians travelling again fairly quickly before the international market opens.
It does seem to be that distance thing that precludes a lot of people that aren't driving, that don't want to drive the long distances, from getting out to the further remote regions.
Yes, definitely. So what's happened in the last 50 years is that people have gone away from having 2 weeks holiday or packing the family up and in the station wagon and driving across the country to these short breaks. And if they want to go somewhere, they want to be pampered, which seems to be why the cruise industry and the Bali option are so popular. But we're not quite offering, I don't think, equivalent things in Australia, or we're not able to offer them at affordable prices, at comparable prices. So, the sooner the tourism benches can find cheaper ways of being able to compete with the international market, the more chance we have of rebuilding the industry.
Thank you.
John, Daryl Stewart, if I get back to production and productivity, there's a third P that should be in there too, which is profitability. Having spent a lot of years in the pork production industry, pretty au fait with the difference between production and productivity. But once you start trying to increase productivity, you can get a very steep curve for a start, which will then flatten out. And you get to the stage where any increase in productivity is then unprofitable because your inputs then exceed your outputs. Yes, and unfortunately, the changes in production are often like a series of steps. So you make a capital investment in new infrastructure or new technology, and it takes some years for it to pay off. So you go up in these steps, and then you make another investment and go up another step. But you don't know ahead of time necessarily which ones are going to work. So that's the risk involved in production. This stuff isn't easy, and primary producers are taking risks, and some of them don't work and some of them do. But it's really important across the sector that there are improvements over the longer term. But yeah, it's tight and prices tend to be lower, so it's often
very, very tough in primary sector to achieve it.
And then you get some politician that allows imports to come into the country, which are subsidised in country of origin, and you're back to square one again.
Yep. Trade policies, which we haven't talked about much, but trade policies are like another random impact on agricultural production and markets that can be good and can be bad.
Don't think we've got any more questions, Professor Rolfe. I think we've
we've
exhausted everyone's brains over lunch. It's always a pleasure. It's great to. I always learn something. It's I think that that productivity one over industries will be an interesting one. The next one on July the 2nd. I think that'll be interesting to look at that one.
Yeah.
Very good.
Very, very good. Well, thanks everybody for attending and listening. It's great to have so many people involved.
Well, I think that's been good, and I've worked out my best way to get these online now, because I've got a few of the others webinars up on the website now. So if people have missed or looked at these, I've worked out a good way to embed them on our website at ruraleconomies.org.au. So I'm putting them up bit by bit. So I've got 3 up, and I'll get this one up pretty quickly. So that's great. Thanks for that, John. And thanks Daryl and Simon and Leon and Tony and Laurel and Graham that's still there. Thanks for all that.
Thank you, Ben and John.
No worries.
Yep. Very good. No, thank you. Good.
Talk to you soon.
Goodbye.